Well, hello, good afternoon, and welcome everybody to this event looking at the reform of our tax system. I'm Paul Johnson, I'm Director of the IFS, and it's my pleasure to welcome you to an event which is not essentially about the COVID crisis, but about looking at policies more appropriate for the medium term. Of course, it's likely that we're going to need higher taxes over the next few years. We've said that on a number of occasions recently, given the state of the public finances, the likely path of growth and the likely needs to keep spending going over the next few years. But we shouldn't just be talking about the level of taxes, but also how we raise taxes, because if we're going to increase taxes, it's all the more important that we have a system that is efficient and fair. So this is an event about a report that takes a pretty deep dive into a particular part of the tax system, and particularly where employment and self-employment and owner management meet, because that's where some of the most important aspects of tax design become very clear. And it looks not just at what a well-designed tax system might look like in the long run, but also how we could start moving towards that goal. It certainly, I hope, will provide plenty of food for thought. It, of course, builds on and develops work that we've been thinking about for a long time and that we initially did set out in the Merleys review nearly a decade ago now. So the format for today is fairly straightforward. You'll hear two presentations. The first will be from Helen Miller, Deputy Director at the IFS, who leads our work on tax, and she'll lay out the big picture, as it were. And then Stuart Adam will talk a little bit more about the details of potential policy packages. They'll speak for about 45 minutes in total. There's plenty to cover and quite a lot of important issues there. Then we've got plenty of time, of course, for Q&A. As ever, we are using the Slido app, so please use that to submit questions. And we're very keen on having questions and input into this. We see this report as very much part of an ongoing debate about exactly what reforms we should be looking at in the coming years. So we hope you'll start that with us today. Finally, and possibly even most importantly, I'd very much like to thank the Nuffield Foundation, who very kindly funded this project. I'll leave it there. I'll hand straight over to Helen. Thank you very much.
Great. Thank you, Paul, and hello, everyone. I thought I'd kick off our talks today just with a quick overview of what's actually in the report. It's a long report, but it's really intended as a reference on a number of important issues. So we're going to be covering how different legal forms and types of investment are actually taxed at the moment, and the kind of long list of problems that creates. We're setting out a long run ideal for what a well-designed tax system would look like, and perhaps importantly, the sort of set of components you'd actually need to put in place to achieve that. And then we're really engaging very seriously with how you might take steps in the right direction. And that's because, as Paul said, despite the fact that we've known about these problems and the solution for decades, we really aren't seeing any moves towards that. And that's partly because the long run ideal seems a bit big and scary and kind of out of reach. And the big message for today is that there is a middle ground between no reform and the full reform. We can take sensible steps in the right direction and start moving towards a fairer and more efficient tax system. So that's what the report does. And as Paul said, I'll give you a high-level overview of the problems and the long-run intuition behind the solution, and then Stuart will take you through the nuts and bolts of what we're actually suggesting. Before I talk about tax, a quick word on business owner managers. They're the group we're going to be focusing on today. And what we mean here is either self-employed people, so possibly sole traders or partners, people who are working through unincorporated businesses, and company owner managers, so individuals who are the owners and managers of unincorporated businesses. There are about 5 million self-employed people in the UK, and about 2 million company owner managers. And there are a huge number of things you can say about this group. We've done lots of work on them, but there are just three things I wanted to highlight for the purpose of today. The first is that these groups have been growing really quickly. They're by far the fastest growing part of the UK labour force. And all of that growth in the last decade has come from single owner companies, so sole traders or single director owner managers. The second thing is that these are a really heterogeneous group. This population covers everything from gig economy workers through tradespeople, IT consultants, doctors, lawyers, accountants, right through to the really innovative high-tech brand new startups. So big variety in what people are actually doing in this group. And the third thing is when you look at the changes over time, the thing that stands out most is there's been a really big fall in the number of business owners who are either employing somebody else or making any kinds of substantial investments. Just to share one statistic with you, the share of business owner managers with employees has gone down from 44% in 1975 to 15% today. So a really dramatic shift in the nature of businesses. One way to think of this is that it's now increasingly the case that more people are simply selling their labour through a business vehicle as opposed to doing any real business activities. So this is the group we're going to focus on in this report. And what we're really looking at is how you tax the incomes of these people and how you tax the investments that they may be undertaking. So let's look at what the tax system looks like today. This is a graph that many of you will have seen me present before. What it's showing you is take an example job that generates £40,000. How much tax is due on that job, whether it's done by an employee, a self-employed person, or a company owner manager. And that's including all taxes, so including employer NICs for the employee and corporation tax if an owner manager is paying themselves in dividends. So it's really thinking about how much tax overall happens on that job. And what you can really clearly see here is the big tax penalty in employment. Work that happens through the employment legal form gets much higher tax rates. And in fact, there are a whole bunch of other preferential parts of the tax system for business owners that you can't see here, including things like capital gains, preferential rates of capital gains that can make the rates even lower for business owners. So we have big differences in tax according to legal form. Now, for the tax base, I can't show you kind of a jazzy picture, but the message is very simple. Tax incentives are a mess. And I say that because the effect of tax on investment varies with all sorts of things, including asset type, source of finance, how long an investment lasts, the inflation rate, and so on. And it varies with these things for absolutely no good reason. The punchline is that in different types of investments can either be untaxed, discouraged, or subsidised, depending on their characteristics. So, for example, just to give you two examples, there's a disincentive to invest money in a company, but a pretty big subsidy to most debt-financed investments. And there's really no reason why we should be having these inconsistent treatments. Alongside all of this, there's a discouragement to risk-taking. And put simply, that's because the relief for losses is less generous than the taxation of gains or profits. You can think of that as saying that the government takes a bigger share of the upside of a project than it does of a downside of a project, and thereby discourages risk-taking. So this is what's going on with the tax base. And this combination of big differences in rates and a base that's kind of all over the place is creating really quite a lot of problems. At a high level, let me just set out what the three are. I think the one that stands out most obviously is just simply the unfairness. People with the same overall income get very different tax bills. Now, I showed you an example at £40,000, but it's true right across the income distribution. And it's perhaps worth noting that business income accrues disproportionately to the top 1%. And if you're looking at that group, you have tax differences that run into the many tens of thousands of pounds. These are really big differences for people doing with the same overall income. The second issue is economic inefficiency. And we talk about this a lot in the report and go through all the different ways in which this occurs. But the basic idea is that because the tax system distorts a whole range of choices, including how people work, what type of form they have, the type and timing of income, the allocation of capital, how much risk they take, and so on, that effectively ends up reducing aggregate output and well-being. So not only are some of the individuals directly in these businesses affected, all of us are made poorer because our system is doing more to reduce output than it needs to. And then finally, and this will resonate with anyone who has to deal with this system in a practical sense, we've created a huge administrative burden for ourselves. There are many boundaries in the system between, for example, the self-employed and employees, or between different types of assets, which means a lot of time and effort has to be spent just administering this system and dealing with it, which could be better spent elsewhere. So that's a high-level view of the problems with the system. Before I tell you about the solutions, I just want to pause on the fact that the rate differences aren't justified. So I think some people tend to think, well, we have these big rate differences and there are some pros and cons and therefore there are trade-offs. But actually the three main reasons that are often put forward for the rate differences just simply don't hold. So one of the claims is that the self-employed get lower rates of national insurance contributions. That's true. And that they reflect lower access to publicly funded benefits. Now, while it is the case that the self-employed do get slightly fewer publicly funded benefits, the NIC's advantage for the self-employed is far, 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 far bigger than any benefit differences. So that simply can't justify the current tax rate differences that we have. The second claim is that the self-employed should get lower tax rates because they don't get employment rights. Now, I completely understand this sounds intuitive, like it must be right. It just turns out when you work through the logic, it's not right. And I'll just share briefly the intuition with you, and we can come back to this in the Q&A. But the intuition is that employment rights are not a transfer from the government. They are basically a transfer from employers to employees. So they affect both sides of the labour market. Anything that makes employees better off makes employers worse off. So employment rights aren't making more employment positions in the economy. And since they're not skewing the labour market towards employment, there is nothing for the tax system to try to offset. All the tax system is doing is pushing people away from employment. It's making fewer employment opportunities in the economy. It's not offsetting anything. And then the third claim, which is common, is that lower rates incentivise entrepreneurship. The message here is that preferential rates for all business owners, including those who aren't particularly entrepreneurial, are just very poorly targeted. And as I've already mentioned, we have a tax base that's really bad for things that are genuinely entrepreneurial, like investment and risk taking. So if what you want to do is incentivise entrepreneurship, our current system isn't well designed to do that. So we have this system, there are big problems in it, we can't justify it, what do we do about it? So I'm going to try to sketch out at a very high level kind of what the long run, well-designed ideal is. And what we're really aiming for here is what we're going to call a neutral tax system, by which I mean similar activities or similar people should be taxed in similar ways. That's not some hard and fast principle, but neutrality tends to be what gets you a more efficient, fairer, simpler tax system. There are going to be some reasons to deviate from it, but they're going to be rare. So you think of neutrality as the benchmark that we're trying to achieve. And if you're trying to achieve that, then there are two goals that you kind of want to go for. One is to tax all income the same, and the second is to not discourage savings and investment. I think most people think those both sound pretty good, but there's a perceived tension, especially among policymakers, where the concern is, does this mean that we tax income from capital, by which I mean dividends, capital gains, self-employment income, like labour income, in order to achieve the first of those goals, or do we not tax capital income at all to achieve the second? The main message for this is that the tension doesn't really exist. It only exists if you're trying to use tax rates to achieve both of those goals. Then there is a tension and you have a horrible compromise that doesn't achieve either of the aims. What you should do is get around this by fixing both tax rates and the tax base, so the definition of what is actually taxed. In particular, what I mean is we should tax income from all sources under the same overall marginal rate schedule. So thinking back to the graph I showed you, that means that all those bars should be the same height. Different components can make up the bars, but the bars should be the same overall height. On the tax base, you should give full deductions from the tax base at both the corporate and personal level for amounts saved and invested. And you should make loss offsets as nearly symmetric as possible to taxation of profit and gains to stop the discouragement of risk. Now, I realise that sounds pretty abstract, so let me just try to help with the intuition a little bit. I think it's worth thinking about, imagine I'm a business owner, I'm undertaking a project that's only just worthwhile, by which I mean it only just covers its costs, including the cost of any investment I've had to do and any cost related to financing. If you take that kind of project that's only just worthwhile and you tax it, you discourage investment because you've turned a project that was just worthwhile into a project that was now loss-making. So you don't want to tax those kinds of projects at all because you don't want to discourage investment. And that's really what we're trying to do when we say give full deductions, make sure the full costs of investment are deductible. There's another way you can think about it, which is equivalent, which might help fix the intuition. This is the basic recipe I just showed you. That's completely equivalent to saying you don't tax the normal rate of return, which is economists speak for basically the return that makes someone just willing to invest. So if you pitch me a business idea, you want me to invest in your company, then I'll only do that if I get at least as good a return from you as I would from a safe government bond. If I don't, I won't make the investment. And again, following the same logic, you don't want to tax that rate of return because if you do, you'll turn a just worthwhile investment into a loss-making investment. So not tax the normal rate of return achieves the second goal of not discouraging investment. Any returns above that, what economists call excess returns, which arise for a variety of reasons, but including where people have been lucky or where there are economic rents like monopoly power, then you do want to tax the economic excess returns, and you want to tax them excuse me, at the same rate as labour income. And that's what achieves the first goal. So different ways of thinking about it, but the same idea, that basically you fix the tax base to get investment incentives right, and then with a fixed tax base, you align tax rates. So that's the kind of high-level solution. Stuart's basically going to walk you through what that means in practice in terms of what do you actually do to capital allowances and loss offsets and that kind of thing. Before I pass over, let me just make 3 high-level points about the solution that we're pitching to you today, effectively. The first is to say it doesn't solve all problems. I put a few examples on the slide here, but it solves very, very many. And so we have a big long list in the report, and this would just wipe away those problems all at once overnight. And that's because, as Paul mentioned, this comes from kind of a much bigger body of work over many decades that considers not just an isolated part of the tax system, but really the whole tax system in all its glory and how it all interacts together. And that's why it solves many problems at once. We're talking here not just about fixing an individual bit of the system, but really about creating a fairer and more efficient tax system. It's also worth highlighting that we've zoomed in on the small business context for this report to make it more manageable, but the solutions extend beyond that context, including, for example, to large companies or to portfolio investors or to landlords. So you don't need a brand new solution in other bits of the tax system. You could extend this and keep moving in the direction for in a broader sense. And it's that, and that's one of the reasons why we say there's really a significant prize here. We could really solve lots of bits of tax. Second big issue, who wins and loses? Obviously, to make any reform happen, you need politics on your side, and winners and losers would be a big issue here. So let me just set out at a high level who that would be. It's worth saying that any meaningful reform would create winners and losers. You don't get around that. Broadly, the winners would be employees and employers. Remember, employees are most of the population. That would be especially true if they had a rate cut as part of alignment. Winners would also include business owners who are investing and making a modest return or who are risking taking a loss. They'll be the types of people who are most likely to be deterred by investment, and they'll win because they get more from the tax base change than they lose from the tax rate changes. The losers will be those who are getting large excess returns from relatively small investments, so those who have got particularly lucky or have got monopoly profits, for example, and those who are simply labelling their labour income as capital income. And arguably, they're people who weren't really intended to get the current tax benefits. And obviously, if you take them away, then you make them losers. So that's what we're looking at in terms of politics about who would be winning and losing. And then finally, I think we couldn't have a talk that didn't mention COVID, at least in passing. And all I really want to say here is that I think COVID makes reform even more important, both broadly because, as Paul alluded to, better designed taxes do less economic damage. And we are definitely at a point in time where we could do with as less economic damage as we can manage. But also because if the government is looking to raise revenue, which, as I said, we think is likely, then I think removing preferential rates in the current system is a very natural place to start. But if all we do is remove the preferential rates and, for example, put up rates on business owners, then we'll be doing that at the expense of worsening investment incentives. There's a horrible trade-off there. So rather than just put up rates, we're saying that you should really engage very seriously with the reform so you can have your cake and eat it. We can have higher rates and improved investment incentives, and that would be a much better way to go forward. Obviously, one political challenge will be that the group we're talking about, some of them have done pretty badly recently. In particular, the government has struggled to design, for understandable reasons, I think, to get a system out of the door that helps all of the self-employed. So we have a self-employed income support scheme, and those who are eligible have actually got very generous support. But as many of you will be aware, many haven't been eligible and therefore are struggling right now. But I don't think that, or COVID more generally, alters the long-run solution that I'm setting out for you today. And in particular, keeping large tax breaks for all business owners, including those who have done fairly well or who have got support, in the long run is simply not justified as a way to help those who are struggling in the short run. So there could be some short-run issues, but there are some short-run issues for some self-employed people. But that doesn't change the long-run solution that means that we really should be taxing business owners on par with employees while reforming the tax base. But let me stop there and hand to Stuart to tell you about what this all means in very practical terms. Thank you.
Thanks, Helen. Good afternoon, everyone. Helen's given you a bird's eye view of what we see as being the ideal long-run solution for this part of the tax system and the rationale for it. I'm going to do two things. first of all talk you through what this long run ideal actually involves in a bit more concrete detail, and second, to talk about what smaller steps you might take in the right direction, given how radical the long run solution would be. So, as Helen mentioned, the long run solution has broadly three parts: align overall tax rates across all sources of income, but give full deductions for the amount that people save or invest, or equivalently, don't tax the normal return to savings investments, only returns in excess of what's needed to persuade people to save and invest. And third, to treat losses as nearly as possible symmetrically to the way we tax profits and capital gains. So, what do these mean in practice? Let me take them in turn, starting with the easiest one, the first one, aligning overall tax rates across different income sources. Helen gave you an example for someone earning £40,000. This shows more systematically the marginal tax rates that apply at the basic rate to income from employment, self-employment, dividends, and capital gains. If you're wondering what BAD relief is, it's business asset disposal relief, what used to be called entrepreneurs relief, just a preferential rate of capital gains tax for people selling their own business. And this includes all taxes, so employer and employee national insurance contributions, corporation tax, and so on, as well as just income tax. This shows the tax rates for basic rate taxpayers. These then show them for higher rate taxpayers and additional rate taxpayers. And so if you wanted to align them all, it would look something like this. Now, for illustration, I've shown this all as being increasing tax rates on income from savings, investment, self-employment. You could also help to achieve alignment by reducing tax rates on employment. We don't have a view as to how high or low tax rates should be overall. The key point is just about levelling up. But to give an example, if you wanted to tax self-employment income as heavily as we tax employment income at the basic rate, bearing in mind that employees' income is subject to employers' national insurance as well, the self-employed mix rate would need to rise from 9% to something more like 20%. Now, the extent of the increase that you need varies. So if you look at dividends, for example, that's actually the lowest taxed of these forms of income at the basic rate. But when it comes to higher and additional rates, it's much closer to tax rates on employment income already. The biggest tax rise of all would be needed for those making capital gains on their own on their own business, getting BAD relief. If they're additional rate taxpayers, they're still only paying 10% capital gains tax at the moment. That would need to be more than 40% to align it with the current employment tax rate. So we are talking about some, not everywhere, but some really quite big changes to tax rates. But in a way, that's just a measure of how bad the current system is. The second element of the recipe is to reform the tax base so that we're not taxing the normal return to saving and investment, but we do tax returns in excess of that. There are broadly two ways that you can achieve this. One is to give upfront deductions for the amounts that people save or invest, it's known as a cash flow tax. The alternative is to give a stream of annual tax-free allowances for the normal rate of return to that investment, what we call a deferred allowance approach. You'd need to do this at both personal and corporate tax levels. So where we're thinking about people running their own companies, you have to think about both the shareholder taxation and the company taxation. For the self-employed, there is only one layer of tax, but we have to think about both parts of that. So let me tell you what each of these two ways of achieving it means, the cash flow tax and the deferred allowance approach. The cash flow tax, well, the cash flow personal tax is broadly how we treat pensions for income tax at the moment. The cash flow corporation tax is how business taxation works, where there are 100% upfront capital allowances, things like the annual investment allowance in the current system. All it means is actually incredibly simple. It just means that you get immediate tax relief on any money that you save or invest, like when you put money into a pension or when you buy equipment that's subject to the annual investment allowance. And then we tax you on any money that comes out of it at the other end. So as it were, like we tax pension income. And that's why it's called a cash flow tax. We simply tax you on your cash inflows minus your cash outflows. And a way to think about this is as the government, in effect, taking a compulsory stake in all investments. So if the tax rate is 40%, then the government will be providing 40% of the outlay through tax relief, but then taking 40% of what comes back at the other end. Now, the government taking a compulsory stake in the investment makes your investment smaller, but pound for pound, it doesn't make it any less profitable. So investments that are profitable before tax will still be profitable after tax. But if I happen to make a very big profit from my investment, the government will tax away a share of those pure profits, those excess returns. And as a result of that, each extra pound I make as a return to my investment, perhaps because really the return that I'm getting from my business reflects the work I'm doing more than a return to the capital I've invested, each extra pound of income can still be taxed in full like income from employment, for example. So that's conceptually what this is doing. How would we need to change the current system to get there? Well, if we think of the three different parts I talked about, for shareholders, we would need to give people tax relief on when they bought shares, including if they put money into their own company, and then tax anything that came out of the shares, both dividends and the proceeds of selling shares, not just capital gains. Second, for businesses making investment, you would have to extend the annual investment allowance so that it covers all business investments. So those are both things that have kind of parallels in what we already do in the tax system. One thing that is different from what we do at the moment is you would have to reform the way that we treat business borrowing, which I think in the interest of time, I'm not going to talk through the detail of how that would work. So that's the cash flow approach. The alternative method I talked about is the deferred allowance approach. So this is a rate of return allowance at the personal level, an allowance for corporate equity at the company level. Neither of those are things that we've ever done in the UK before. They are both in place and done in other countries. And this is actually, while this is unfamiliar to people in the UK, this is actually fairly close to where the current system is, the conventional taxation of corporate profits and personal income and capital gains. You just add in a new tax allowance for a normal rate of return on the investments that people make. Now, that doesn't mean that the normal return isn't something that varies across assets or varies across people. It's just the market risk-free rate of return on investment. In practice, you might use something like the rate of return on government bonds. And so if I invest £100, say, I would get £5 a year tax allowance every year thereafter. And if you set that normal rate of return correctly, that stream of £5 a year forever should be worth the same as if you were giving me £100 upfront deduction as you would have done under a cash flow tax. So it turns out to be equivalent. They have many of the same properties. So in this case, explicitly, we're giving, if your investment only makes a normal rate of return, if it's only just worthwhile, we wouldn't be taxing you at all. But if you make higher returns than that, we would tax you, the investment would still be profitable, but each extra pound of income could be taxed in full like labour income. I won't go through the details of exactly how it's calculated, but again, in broad terms, you would need to do this for share purchases, for the business assets of the self-employed, and for companies. The third part of the recipe is how you deal with losses. So, as Helen mentioned, Ideally, relief for losses should be as nearly as possible symmetrical to the taxation of profits or gains. If I'm considering some risky investment or business venture that could go well or could go badly, if I know that the government will tax me if it goes well, but won't support me if I do badly, that's going to discourage me from taking that risk. And so you want to avoid that, or at least minimizing it, by relieving losses as nearly as possible symmetrically to the way that we tax profits. Now, truly symmetrical treatment would mean that if we tax profits, we give refunds for losses. Giving outright tax refunds might be a step too far, even for those of us in an ivory tower. What we tend to do instead is allow people to, or companies for that matter, to deduct any losses they make from any other income they've got. If they don't have any other income that year, they can carry the loss forward, or to some extent carry it backwards, and offset it against their income in another year. But at the moment, there are all sorts of restrictions on what kinds of losses can be offset about what kinds of gains in which years. And essentially, we would argue for, as far as possible, allowing any losses to be offset against any income or gains in any year. And I'll come back in a few minutes to talk about what that means in practice. Secondly, if you don't have any income in the same year to set your losses against, so you're carrying forward losses to deduct from income in a future year, those losses should be carried forward with interest so that they don't lose their value over time. So that's the long run ideal. But those are radical changes that I've been talking about. The tax rates, to the treatment of investment, losses. You clearly can't do all of that at once or quickly. It probably isn't even desirable to do it all overnight. We think it is essential to have an ideal and an end goal in mind, but you have to get there a bit at a time. The difficulty is that you can have an ideal that works well as a system, but individual reforms, even if well-intentioned, can be the tax equivalent of playing whack-a-mole, where it solves one problem, but at the expense of another one popping up or getting worse. So if, for example, we just increase tax rates on self-employment income, that would reduce the incentive for employees to become self-employed instead. It would increase the incentive for self-employed people just to set up a company instead. And those people who remain self-employed, because of the higher tax rate, would see worse incentives to invest and take risks and so on. So you have to be careful. There are lots of ways of reforming the system that would make it worse. There isn't one right way to get to the long run ideal. But what we've done in this, in this report, and what I'm going to talk about in the rest of my presentation, is design a set of reform packages that combine components of the long run ideal that I've just been talking about in a way that moves towards the long run ideal, but does so in a way that the individual changes are hopefully, arguably, improvements in their own right, and manage, or at least illustrate, but hopefully help to manage the trade-offs that are associated with piecemeal reform. Now, don't worry, I'm not going to talk through all of the 11 reform packages we illustrate in detail. They're all discussed in the report, but I want to give you a flavour of what they all are and talk about one or two in a bit more detail. So the first set of reforms that we talk about are steps towards just aligning tax rates across different income sources. So forget about doing anything complicated to the tax base. This is just change the rates of existing taxes. And there are lots of different ways that you could change tax rates that would move closer towards alignment across different income sources. So just to take one example, income tax applies to savings and investment income, including dividends, in a way that national insurance contributions don't. So if you increased income tax and capital gains tax while reducing rates of national insurance contributions, you might have no change in the tax rate that implies to earnings from employment, but have an increase on tax rates on dividends and capital gains, and therefore, by changing the tax mix, implicitly move closer to aligning tax rates across different forms of income and different ways of doing business. So that's just one of the ways that we talk about doing it. All of these 5 measures would help achieve closer alignment between different forms of income, but all of them do it in part by having higher tax rates on income from business. And if you do that without changing the tax base, all of these would worsen the existing distortions to investment and risk-taking and so on. So the second set of packages we consider is more the core of what we're trying to do in this report, which is moving towards alignment of tax rates while also improving investment incentives. So if you think back to the components of the big picture solution that I was talking about earlier, I said one way of moving towards a cash flow tax would be to broaden the annual investment allowance so that we're giving immediate tax relief for more forms of business investment. So that's one way that you could do it. An increasing tax rate while broadening the annual investment allowance would improve investment incentives overall, while also getting closer alignment of tax rates. One of the major problems in the current system is that taxing shareholders on their dividends and capital gains discourages people from investing in companies, whether that's their own company or someone else's company. I said that a cash flow tax could solve that problem. So the next reform we look at is introducing the cash flow personal taxation of shares. So it helps to give these things a name. So we've called this a personal shareholding account, but basically it works like a pension. The money that you put into it doesn't get taxed. You get tax relief on your contributions. There's no tax on the income while it's within the account. Whenever you get the money out, it's taxed. The difference is that, unlike with a pension, the money in the account will be used to invest in new shares that company issue, including can be shares in your own company or a family member or whatever it is, which clearly you can't do with existing pensions and ISAs and things like that. So, as I explained earlier, with the nature of a cash flow tax is such that those who are on the border of whether or not it's worth investing will be no longer taxed for doing so, whereas people making big returns will pay more, but it's still going to be worth it for them anyway. And so introducing the personal shareholding account would allow you to increase tax rates on dividends and capital gains while no longer discouraging people from investing in companies. Another element of tax-based reforms that I talked about earlier was making loss offsets more flexible to treat losses more symmetrically to the way that we tax profits. So to give you a more concrete sense of what this means, at the moment, if you're self-employed and you make a loss, if you have other income that year, you can actually set your self-employment losses against that other income quite flexibly. But if you don't have enough other income that year and you carry them forward, at the moment, you can only set that loss against future profits from the same trade. And we were suggesting, well, why not let people offset carried forward losses against future income from their next their next business venture or their next job if the current one doesn't deliver any profits in future. So again, if you think I'm self-employed, I'm thinking about starting up in self-employment, it gives me that much extra reassurance to know that if for whatever reason it doesn't work out, the losses that I make from that business, I will be able to deduct from my future earnings or from my next business. So other ideas slightly more quickly. At the moment, if you make a capital loss, if an asset falls in value, most of the time you can only offset that against capital gains, not against ordinary income. There are some circumstances in which the current rules do allow you to offset capital losses against current income. We argue that that could be extended to a wider range of circumstances. At the moment, you can carry losses not only forward, but you can carry them back, sometimes for 1 year, sometimes for 3 years, sometimes not at all, depending on circumstances. We would argue let people carry back losses further, more consistently. And finally, as I mentioned, where losses can't be deducted from income in the same year but are carried forward, they should be carried forward with interest to maintain their present value. Now, the key challenge for any of these kinds of reforms to the tax treatment of losses is what can be done without creating new scope for tax evasion or tax avoidance. HMRC has put a lot of work over decades now, really, into trying to clamp down on abusive use of losses for tax purposes. Now, from the investigations that we've done so far, we haven't encountered any reasons why we think that doing these 4 things that I've described should actually create any new opportunities for evasion or avoidance. But this will clearly need some careful examination by people with real technical expertise before you actually did it. It may be that some of these can't be done, or at least can't be done in quite such a wide-ranging way as I've outlined. But we're reasonably optimistic that actually at least some moves could be made in these directions. And if that is the case, you could then increase headline tax rates while we would still be discouraging risk-taking much less than we do at the moment. Another thing you could do in terms of reforming the tax base is indexation for inflation. So it used to be the case that under capital gains tax, and for that matter, corporation tax, we would only tax capital gains in excess of inflation. So if your asset rose in value just because of inflation, not because of anything more than that, you wouldn't pay any tax. We would like to bring that back. I think it could actually be done rather more simply than the old system used to work. And this would also be a step on the way to the rate of return allowance that I described earlier, which can be thought of as giving indexation for an interest rate rather than an inflation rate. But indexing for inflation would be something that's a bit more familiar and will be a route towards that. The third kind of reforms package that we look at are really intended to illustrate how you could introduce reforms to this part of the tax system in combination with changes that are from wider areas of policy, but link into them. So, for example, you could widen the access that the self-employed have to social security benefits in return for increasing the tax rate they face. One particularly interesting one I'd like to talk about that we haven't mentioned so far is what happens with capital gains tax at death. So at the moment, if I have an asset that's risen in value, but I die without having sold it, that capital gain never gets taxed. My estate isn't taxed on it, and the person who inherits the asset is deemed to acquire it at its value when I died, not what I originally bought it for. So the rise in value from when I bought it until I died just never gets taxed. And that's a horrible feature of the tax system. It creates a huge incentive for people to hold on to the same asset until they die, even if they'd rather do something else with their money, even if someone else could use that asset much more productively. And worse than that, it's also a feature of the system that if you increased the capital gains tax rate with this in place, it would just make that incentive to hold on to things until death even bigger. So this would actually be quite a good place to start with reform of the system. That is something you could do in isolation, but it would also be something where it might make sense to think about this in conjunction with reforms to things like inheritance tax that also affect how things are treated at death. So, to sum up, we've set out a long-run ideal which involves combining alignment of tax rates across income from all sources with reform of the tax base to avoid discouraging investment and risk-taking. That reform will be quite radical. We set out various ways to take smaller steps in the right direction. Now, even with smaller steps, none of this is going to be easy. There would inevitably be a lot of losers from any meaningful reform. We would argue that those are people who are largely getting unjustifiable tax advantages at the moment. It's also worth bearing in mind that the system we've got at the moment is creating all sorts of problems and means that some people, including ordinary employees and employers, are unfairly having to pay more tax than can be justified. And what's more, if, as a result of COVID-19 or for whatever other reason, you increase tax rates on its own, that would make all of the existing problems in the system worse. So we've set out what we think is the long-run ideal. We've set out what we think are some promising ideas for how to move in that direction. People will no doubt raise objections to all of them, but if you don't like any of the reforms that we propose, my challenge would be, if not these, then what? And I'll leave that with you.
Well, thank you, Stuart, and thank you for leaving people with that that challenge. There's some response to it. There's a very large number of questions already on Slido, and if other people want to add theirs, or if they want to send my attention towards any of the ones that are there, then just vote for those, because I see at the top of the screen those that have been voted for. Why don't I start with the one right at the top of my screen, which is asking whether this is us promoting the findings of the Merley's report, which I think in broad terms it is, but Helen, perhaps you could explain in a sense how this is developing on that.
Sure. So yes, it's completely consistent with and building on the Merley's report. The Merley's report set out effectively the same kind of long run ideal that we're setting out. I think we're doing two things that are different. I think one is we're just putting much more detail down on paper about that. So rather than just sort of setting out the high level that I do, we're really working through, worked examples, how it would work, what we've been in practice to make this feel much more tangible. And then, as Stuart set out, really trying to break that down into manageable steps in the right direction, because we're very well aware that we've had that solution out there for a decade and we're not moving towards it because it's seen as too big and scary. So we're really trying to show people that you can do specific things that are smaller and more manageable that move in the right direction. So that's what's really new about this report relative to the Merley's report.
So question here, which I'll direct at you, Stuart, which I think gets to your point about the importance of looking at the tax base as well as tax rates. Why not simply increase all the income tax rates by the employer and employee NICs rates? Doesn't that just solve the problem?
Well, if you just increase income tax rates by the amount of NICs rates, that would apply to employees as well. So that would be a tax rise for everyone. If you increase income tax rates in effect just on dividend income, capital gains, self-employment income to match what they are on income tax, give or take adjusting for corporation tax and all the rest of it, that would basically get you there in terms of aligning tax rates across different income sources, across different legal forms. The problem you would have with that is just increasing income tax rates without changing the tax base would mean that you're disincentivizing investment, risk-taking, all of the other problems that I was talking about.
I think that point about the tax base there is really important. Yes, we do want to align rates, but you need to, in a sense, narrow the tax base if you're going to avoid those disincentive problems. I'm afraid there's a question here which I will I think we need to address. Why does the IFS keep campaigning against the self-employed people like me doing my best, demanding we get taxed more? Surely enough is enough. I think in broad terms, we're absolutely not doing that. And indeed, as Stuart has laid out, some of the proposals would result in less tax being paid by some of the self-employed, but more overall, reflecting the fact that they are less highly taxed than employees at the moment. You might look out for what we're going to say tomorrow, indeed, about the inadequacies of the self-employment income support scheme. But Helen, perhaps you could tackle that one, because it's a question we get asked quite a lot, and it's important to be clear. We are in no sense do we have any kind of problem with the self-employed. We're really looking at a problem with the tax system where that conjunction between business owners, the self-employed and employees really hits home, and it really is clear and damaging how very, very differently they're taxed.
Yeah, so let me just echo that loud and clear. There is absolutely no campaigning against a group, and there's certainly no moralizing going on here about people's behavior. This is really in some ways a much colder sort of forensic look at the tax system and the problems it's caused. And I'd mention the same things that you've mentioned, in that some people would benefit actually quite substantially from what we're suggesting. So this is not a hit to all self-employed people. Those who are actually making relatively modest returns would see a benefit to this. So it's not that. It's also not necessarily against low-income people. In fact, what we're saying is if there are concerns about low-income people, we should be equally concerned about low-income employees as self-employed people. So in some ways, let's share the love. Let's not just help self-employed people, let's help employees too, make sure that everyone on low income has equal access to government support. But nevertheless, we are saying that tax rates should rise on the self-employed. And again, I understand why that's difficult, because once you've got a tax break, it doesn't feel like a tax break to you. But 85% of the workforce are employees. They are effectively paying higher taxes for the same services from the government. And I think that is unfair. And therefore, we should be unwinding that unfairness. Not necessarily all overnight, not necessarily even starting this year. In fact, not starting this year. But I think a long run goal where we do that is a good thing. And one final point I'll make is that we've seen this massive increase in self-employment. I mean, we have almost the fastest rate in the OECD. It's no coincidence that that's happening alongside these big tax breaks. And for lots of those people, they'd actually rather be employees and get the employment rights and things that come with that. And our tax system is pushing employment out of the reach of more people. So I think we want the tax system to get out of those decisions, to stop distorting the labour force, so that the people who want to be self-employed, great. We want to help them invest and employ people and grow and be great. But for those people who want to be employees, we don't want the tax system to be reducing their opportunities. So then this is really about helping people and helping the overall system, certainly not about penalising a particular group.
Let's go on to a quite specific one here, which is about treatment of deductions. How would you do that at an individual level, Stuart? Wouldn't that require everyone to be filling in lots more tax returns? Doesn't that make a huge amount of additional complexity?
Well, there are different ways that you could do it. I think it doesn't necessarily need more people to fill in tax returns. No, I think the first thing I point out is that you can get quite a lot of capital income without kind of tax-free anyway. So if you're saving in a bank account, there's the personal savings allowance, there's ISAs, there's all the rest of it. So, and it depends exactly which part of the system, which specific proposal we're talking about here. But bear in mind, that companies, the self-employed, are generally already having to fill in tax returns. So really the people we're talking about here are company owner managers. Again, many of those will be filling in tax returns already. You will continue to have tax-free allowances, which will take many people out of tax. There would be some more people filling in tax returns. It depends exactly which way you do the various things that I was talking about, but there needn't be any dramatic increase in complexity from it.
There's several questions here, Helen, which really asking effectively how well this goes down with Treasury HMRC. I mean, I don't think you can reveal the content of private discussions, but I mean, what's your sense of the sorts of proposals as engaging policymakers?
So obviously, I'll let the Treasury and the policymakers speak for themselves, but clearly everyone knows that Philip Hammond tried to do a tiny change to NICs and got burned. So everyone knows this is a difficult area and that the politics of this are difficult. But the Treasury, I think, also understand the economics of this, and they can look at the tax system like we can look at it, and they can see the glaring inefficiencies. And we're doing research, for example, using HMRC tax records, and obviously Treasury can see those too. And you don't need to squint very hard to be able to see the big effects that tax is having on people's behaviours, on how owner managers organise themselves, and how they change their dividend timing, for example. So I think Treasury can see the inefficiencies, and I think like the rest of us, they want the taxes to have the less damage as possible. So if you can do things that make the country have more investment incentives, be more entrepreneurial, be better towards genuine risk taking, I think that is all very attractive. So obviously, as Stuart said, this is going to be difficult, and the politics here, I completely understand, is tricky. But I don't think these are seen as completely wacky. Why would you even think about this ideas? I mean, nothing I'll mention is that that's I think caught Treasury's attention is that as we've had this massive growth in business owners, you've seen the cost of the tax breaks going up, because now you have millions more people moving into lower tax brackets. That means the government is getting billions and billions of pounds less money than they expected they would have done, had that change not happened. So I think also just the revenue loss is going to be focusing minds.
A question here, which I think is quite important, Stuart, about whether money in a business is invested in order to generate taxable income, rather than just put in there as a tax shelter. Do the proposals help or hinder those sorts of problems?
I think the answer is that we would say it doesn't matter. We're not making any attempts to distinguish, why you're doing it. The bottom line is, if you make high returns on your investment, if you get a lot of money out of it, we'll tax you. If we don't, if you don't, we won't. And part of the theme of the direction we're going in is that if you just if you have money that could be taxed today, but instead you choose to shelter it and tax it in and so that it's only taxed at a year, 10 years down the line instead, as long as we also tax you on any returns you've made in the meantime, when you get that money, when you do eventually get that money out, I don't particularly mind if you want to shelter it in the meantime. In fact, being taxed for sheltering your money is another way of saying being taxed for saving. And I'm not really particularly bothered if people do that. But we do want to make sure that if you make a big return on that money in the meantime, we end up taxing what you get from that return as well as what you had in the first place.
Which rather brings us on to another question here, which is, isn't the government effectively moving in the opposite direction by reducing tax relief for pension contributions? Because I don't disagree with what you said, Stuart, but chancellors might disagree because of the timing of the receipts. Sorry, Helen, do you want to come on that?
So yes, governments have moved in that direction with pensions, and I don't think that's necessarily a good idea. We have a long discussion about what you do with pensions. Obviously, relief up front, feels worse to governments, but we think it shouldn't. And remember, we're not just talking about giving more relief up front. We're also talking about putting much higher tax rates on that income that is sheltered. So to say what Stuart was saying differently, the reason we care about sheltering now is not because it's sheltered per se. If people want to shelter their money, let them shelter it. It's that you can currently take your labour income, which might normally be taxed above 50%, and then keep it in your company and get bad relief and get much lower rates. So those lower rates are making you shelter, and you're sheltering just for tax purposes. And what we're saying is, under our scheme, there would be no tax benefit to sheltering. So if you wanted to shelter, go for it, but you wouldn't get a tax benefit from doing it. So only those people who wanted to do it would do it. And that should be like pensions. If you want to, those people who are saving, they can save, and we should be stopping them from doing it. So I think we want to move more towards the pension scheme, in the sense of letting people save when it's best for them, but not trying to, make them save in order to get lower tax rates.
Sure, there's an interesting question here about VAT. It says that we seem to completely ignore VAT. Most self-employed people working via limited companies pay significantly more tax than their full-time equivalent counterparts. Do we need to worry about VAT in this context?
Yes, we do. I think the answer for why we're ignoring it is just because we were trying to keep this manageable. As you will have seen, we've already covered a huge amount of material today and huge swathes of the tax system. We were limiting attention to direct taxes. There are issues with VAT. I'm not sure exactly what the question is referring to. I wonder whether it's talking about essentially one-man bands being much more likely to be below the VAT threshold, whereas if you're a company employing lots of people and doing everything as one organisation, then you're likely to be above it, and therefore VAT creates incentives to structure a set of activities in one way rather than another. That is true. There are things you can do with the VAT system to deal with that, but I wouldn't try to change what we're doing with income tax and corporation tax and capital gains tax in order to deal with that issue with VAT. So yes, it is an issue. I'd be delighted to talk about it, but I think it's one for another day.
That's fair enough. There's a question here which I think gets at in a sense, again, back at the nitty gritty of this. It says, although many self-employed may be close to being employees, many generate new business and income taking a risk when they do so, so it can't be compared to employees. I think I'd be right in saying that where we're looking at people investing and taking risks, the whole point of this is that the proposals here would potentially be quite beneficial to them. Is that right?
Yes. I mean, what I have to think about, sorry, Stuart. What I have to think about this is that we are absolutely acknowledging that self-employed are different. But what we're saying is that they're not different simply because they have a different legal form. That's not the important point. That what makes them different is if they're actually taking their own money and putting it into their business, or they're investing in physical assets, or they're taking risks. It's that makes them different. And that's exactly what we want to fix. We want to be more generous towards people putting money into their businesses, people buying assets, people taking risks. So we're being more generous to those types of people and just saying, in some ways, let's move the tax benefits away from just all business owners, everyone, just because you happen to have a label, and move it towards those people who are genuinely doing investment and risk taking. So this is really a reorienting of the tax system, I think, away from all business owners, including lawyers in the city and doctors, and moving it towards people who are making investments and risks. So it's exactly treating them differently, but treating them differently in the way that matters, not just because of the legal form label.
A very broad question here, which I think is probably on a lot of people's minds. How do you turn these ideas into reality? What are the political obstacles and how do we overcome them?
Well, hopefully today is step one. We're telling people how to do it. So more seriously, I mean, I think we're trying to play our part in terms of setting out what we think is a good long run goal. And we'll talk to anyone who wants to talk to us about steps in the right direction. I think what we can do is try to help explain the problems and how we could fix them. And, hopefully, and it's already happening. We spoke to a lot of people as part of this project, including a wonderful advisory group that gave us lots of input. I think more people, especially relative to even 10 years ago, even 5 years ago, more people are engaging with this issue and want to talk about solutions. I mean, one thing we said in the report is that everyone is unhappy with this system. They're just unhappy for different reasons. Some people worry about the low-income self-employed, some people worry about inequality, some people worry about investment incentives. They're all part of the same problem. So I think really the tax community, by which I mean very broadly the tax community, could really come together and help have the debate about which steps do we pick first, how do we move first, when do we move, and in some ways make it easier for policymakers to make those steps. Because at the moment, if they take a step and they're instantly gunned down, it doesn't work. I think we have to acknowledge that, like Stuart was saying, we need to make reforms. Let's kind of try to discuss, what they should be. Of course, alongside that, policymakers need, I think, to be honest with the electorate about the fact that there are these big differences in tax rates that aren't justified, and that removing them is going to be hard, but nevertheless, we should do it.
If I could just add to that, I agree with all of that. I'd also say that I think one thing, maybe I'm naive, but one thing that I hope could help with reform is if it is motivated by a clear vision and a clear narrative of what we're trying to do, what the current problems are, what the logic is of what you're doing, rather than it just being seen as, we're trying to put up tax rates for the self-employed or whatever it is. I think it's interesting, in terms of the politics of it, Demos did some interesting research a few months ago, kind of combination of opinion polling and focus groups, which asked people questions like, if the self-employed got the same benefits as employees, should they then pay the same tax rates? And should capital gains be taxed at the same rates as ordinary income? And basically, the support for what looked rather like the agenda we're talking about was actually quite high. I think it's partly just about motivating it and making people see that there is a logic and a justice in what it is, and it not just being seen as, here's a tax grab on a particular group because we want to raise more revenue.
Yeah, the challenge is always that once the proposals are on the table, those who would actually lose out tend to shout an awful lot louder than those who would gain. But that is true of all tax change, and something that governments do need to find a way of overcoming for sure. I'm going to ask the question at the top of this list. I don't know whether it's one that you can deal with, Stuart. It's questioning whether the loss relief rules might bring back more disputes about the distinction between a hobby and a business. Is that something you can deal with?
Yeah, Stuart loves loss offsets.
So, I mean, the distinction between a hobby and a business is an issue in the tax system at the moment. It's not just about hobbies. It's broader than that. It's things like, if I'm self-employed and I buy a laptop or a car or whatever it is that for my business or is that for my personal use? It's very difficult to distinguish those in the real world, let alone for HMRC to police it. So that is a problem in the existing system. In that sense, our proposals aren't adding any new problems to that. But by making loss relief more flexible and also by giving bigger deductions for investments, it would make the number of times that particular problem arose would be higher. So, for example, I talked about extending the annual investment allowance to cover all other forms of investment. One example of that would be training. Now, the Treasury did a consultation a couple of years ago on should they widen tax relief for training, and what were they worried about? It was exactly, would people claim their, skiing holiday as training to be a ski instructor and that kind of thing. And so, the ideas we're talking about wouldn't create any new problems. That particular problem it would make arise more often. But I would say at the same time, there's a whole bunch of other problems that would arise less often as a result of what we're talking about. So yes and no is the bottom line to that.
There's a sort of question here which I think could have broader applicability. It's a question about whether the changes to the tax base would need to be phased in and how you treat legacy investments, money already invested in your company, for example. And I suppose there's a more general issue here about transition.
Yeah. So this is a long and complicated one. There's some stuff about this in the report, but it was so long and complicated. We haven't gone into it in a huge amount of detail there either. It partly depends, again, on which of the tax-based reforms you're talking about here. Often there is a choice, and you can say, so if we're going to give more allowances for saving and investment, we're going to have higher tax rates. Do you apply the higher tax rates even to assets that people already hold? Well, it'd be quite difficult not to, but then there might be concerns about unfairness of that. Now, in terms of the efficiency of the system, it actually all you need to do is give deductions for new investment and new saving. You don't need to give deductions for existing ones. In terms of fairness, you might worry more about raising people's tax rates even when they haven't had these more generous deductions for the amounts they've saved and invested. that is an argument, but I mean, that's one that arises all over the place already, right? I mean, if you increase VAT, you're increasing the tax on money you already hold when you come to spend it. There is a spectrum there. In terms of whether the new allowances and so on would apply to new investments only or existing investments as well, you could do it either way. There are pros and cons, and actually different countries do it in different ways where they have these systems in place already. I would lean towards saying just do it for new investments only. A downside of that is that then creates an incentive for people to kind of rebadge old investments as new ones in order to get the relief. I'd say if that, you could introduce lots of anti-avoidance rules to try and stop that. Frankly, my view is that if that happens, it's not the end of the world. You might even want to facilitate it. But it is an interesting and important issue. There are just lots of different ways that you could deal with it.
Okay, we're getting towards the end now. There's another kind of quite big question here, which is really asking what are the downsides? What are the downsides of these proposals, particularly for cash flow taxation and deferred allowances? Or are there none?
No, go on, Helen.
No, I think the big picture is that there aren't big downsides in the sense that because they've been designed to work across the whole system, certainly you shouldn't be expecting the big list of problems that our current system creates, and here's another big list of problems we're replacing them with. I mean, you really should be thinking of you're deleting lots of problems. I think one of the challenges would be that they'd be new, like the deferred allowance approach we haven't done in the UK before, so there'd need to be some learning because it'd be a bit unfamiliar. People need to learn what they're doing, and therefore there'd be a change. So that's kind of a downside, but that's a downside of change. I think the current system sucks, so I think we should eat that downside. And there are a few little technical things that maybe under certain conditions there'll be things you want to work out, but I think there aren't really any big downsides of this approach. You want to add anything, Stuart? Yeah,
so I think I would distinguish here between the kind of the long run ideal and the smaller packages on the way. The long run ideal, I really don't see many downsides to the whole system. The big downside is just the extent of upheaval that would be needed to get there, including all of the winners and losers it would create and all the rest of it. In terms of the individual packages on the way, I think a lot of those do have downside. Most, if not all of them, have some sort of downside. And again, in the report, we do discuss the downsides as well as the upsides. I mentioned that the ones that just involve changing tax rates would all basically make the existing problem with investment incentives worse. Some of the other things like introducing indexation for inflation would make capital gains tax a bit more complicated. Now, personally, I actually think that the benefits outweigh the costs. I think overall, probably all of the packages that we propose would be net improvements on where we are, but some of those packages do have some downsides, and we discuss them all in the report. I'm not going to go through all 11 of them now.
Brilliant. We really are close to the end now, but there's one here which I'm quite intrigued by, and maybe another quite difficult one. It says, can you talk more on ways of identifying risk and uncertainty in an income-generating endeavour? At the moment, some self-employed have very low risk and some employees have high risk. Is that something we should worry about in designing the tax system? It's certainly something that people talk about quite a lot when it comes to thinking about rates on the self-employed, and you talked about encouraging risk, as it were, through loss offsets and changing the tax base. But do we need to think about risk more generally, particularly if we think that some employees might be facing high risk?
So I think the very short 1 minute answer is kind of no. So that we don't really want to encourage risk. We just don't want to discourage it. And we certainly do not want to be in a position where we have to have the government or HMRC trying to decide who's taking a risk, who's not taking a risk, who's taking good risks, who's taking bad risks. I mean, that's beyond, you can't do that. What you want to say is, let people take the risks they think are commercially the right risks. They think they're good risks to take. They're going to have, they're good commercial risks. And then have the tax system be indifferent towards that. So what you want to do is basically say, if the risk pays off, we'll take X%. And if the risk doesn't pay off, we'll share X%. So basically, it's a form of insurance. You'll take an equal share in the upside and the downside. And by doing that, you're not going to discourage risk, but you're not necessarily going to encourage it either. So that's really the goal here. We don't want to be encouraging risks. Obviously, you could start encouraging risks that were horrible risks to people to take. So you just really want to have the government, when they're getting involved in risky decisions, getting involved equally in the upside and the downside, so that then the tax system doesn't matter and people just go about their business doing what's commercially best for them, and that's all good.
Great, thank you. We've come to the end now in terms of talking risk. I think looking behind Helen on the screen with all the crossbows behind her, I think might be quite risky travelling down towards where she's sitting. But thank you all for joining us this afternoon. Thank you again to the Nuffield Foundation for funding what I think has been a really great piece of work, really developing the policy agenda, and one that I know policymakers are very interested in. Thank you all for attending, and thank you especially to Stuart and to Helen for the enormous amount of work that's gone into this report and the great presentations this afternoon.